Today I want you to watch this video and then complete the problem that follows. What we want to do here is take a look at some of the entries that are particularly confusing perhaps when using multi-column journals. Some of these special, particularly end of the accounting period transactions that need to be journalized and posted. So we'll take a look at a ledger here. Then in a moment we'll go back and look at the journal, a couple journals, and explain what I'm talking about. We'll see a couple things that are basically a review, and then a couple new things added to these kind of entries that we will be examining. First of all, look at this ledger. This is the general ledger. We're looking at this account number 103, the computer system. Way back, apparently, on January 1, 2015, we bought a computer system. And we'll use dates at the beginning of the year and the end of the year to simplify things for you. So at the very beginning of the year, we bought a computer system, and we have a description put in here. This is when we can use this description area in the account. It says that this computer system will have a useful life of 5 years, and a salvage value that we expect to get would be $500. So we bought the computer system on January 1 of 15 at $14,500. So if you remember how we do this, we subtract the salvage value, 500, from the original cost, 14,500, and the difference is 14,000, which is depreciated over the course of 5 years. So if you divide 5 years into the 14,000, you'll get a depreciation of $2,800, and that's what's shown in the account just below. This account, accumulated depreciation for a computer system, you see entries have been done at the end of each year. So this business, we will assume, has an annual accounting period. So December of 15, we credit $2,800. Actually, we would have had an entry that debited accumulated depreciation expense for $2,800, and we would credit this account, the accumulated depreciation account. So we have a debit to the depreciation expense account at the end of the year and a credit to this account. Same thing happens at the end of 2016, same entry at the end of each year. So we are now at the very end of 2018, we will assume, for this company, and we've done this 4 times. Now up here in the computer system account, it said the useful life is 5 years. But we're going to, for our purposes here, assume that at the end of 4 years, we're going to sell this computer system. We don't have to wait till the end of the useful life. If we want to, we can sell the thing at any time. So let's take a look at how that would work. At this point, after 4 years, the total accumulated depreciation is $11,200. Now we said the salvage value was $500, but that's after 5 years. This is only after 4 years. So we're going to sell it now. Let's take a look at how this might look in the journal. Because we are selling it, we're getting cash, we have to use the cash receipts journal, and let's take a look at it. We are selling this, again, to make it simple, we're selling it at the very beginning of 2019, January 1, and there are 3 counts involved. These 2 need to be put on the account title line because there's not a special column for those accounts. And we have to, way over here in cash debit, we will debit cash by $3,300. So we're going to assume, and you would have this in your instructions, we will assume that this computer system was sold by us to somebody for $3,300. And we gave that person a receipt, number 37, and we got $3,300. Not the salvage value, we got a little better deal. So $3,300 is debited, and then we need to close these 2 accounts. And we should know by now that by closing it, that means we make the accounts have a 0 balance. So we will debit accumulated depreciation for the computer system by $11,200. Now where did I get that? I looked in the general ledger, and the total for this account, accumulated depreciation for the computer system, is $11,200. So I need, on January 1, a debit of $11,200. If I do that, it'll close the account. So that's how that's handled. That's where in the cash receipts, that's where this number 11,200 came from. The computer system we no longer have. So we can't keep that balance in that account. We need to close it. And we use 14,500 because that's what's in the account. In the computer system is 14,500. If I credit in the journal, I credit here. And that again would close the account. We're not posting right now, but that's what would happen. If I did do the posting, then back in the cash receipts, I would fill in the posting reference column. So that's why this kind of account in a multi-column journal takes 2 lines. You still have 2 debits, 11,200 and 3,300 will add up to the credit of 14,500. 2 more quick things about this entry. First of all, we haven't used this recently, but we did back in the general journal. It helps sometimes to put a description of what this is all about. This doesn't have to be there. It's not required, but sometimes it helps to describe what this particular 2-line transaction was all about. So we sold an old computer system, so that's what we put. Another thing that's sometimes done just to clarify things and to separate one transaction from another is to skip a line. So here you see a line skipped. On the same day, we have cash sales. Just to review, we don't need anything in the account title column. We don't need to post anything individually. The source document is a cash register tape with the date, January 1. And then we credit sales by whatever that amount is. And we have to credit sales tax payable. And the total of what we got for the cash sales for that day was $105.75. So that's how this works. Just remember that when you sell an old asset, use the cash receipts journal because you're getting cash, you're getting some cash for it, but you will have to use 2 lines. And remember, with any transaction, no matter how many lines you use, the total debits in that transaction have to equal the total credits. Now, let's take a look at another kind of transaction. Let's go now to the cash payments journal. And we're using today's date, and let's assume that the transaction for today is what's already journalized, and that is we bought a delivery truck. So that's on the account title in that column, and the debit would go to that account. So we are assuming the delivery truck is worth $62,000. But cash is used here. We wrote a check, that's the source document, but we didn't pay the whole thing. We only paid $2,000. So that's why cash is credited $2,000. And so we took out a loan. Now we don't use accounts payable. We wouldn't debit accounts payable anyway, because this is a long-term, not a short-term liability. So we don't use that column, but rather we use an account called loans payable, and that has to be credited. It doesn't have a separate column in this journal, so we have to use general credit. So that's why it takes 2 lines. And again, to double check, the debit has to equal, in this case, 2 credits. In every transaction, that's the case. Okay? And if it's posted, we would have the 2 account numbers put there. And finally, a third line would simply be a description. As I said earlier, this is not required, but sometimes it helps to clarify. So let's go to the general ledger. If this has already been posted, then we have an account called delivery truck that has a debit of $62,000, and after this date, it probably is not going to be used until we sell the truck years from now. So we want to keep that amount there, and each accounting period, whether it's a month, whether it's a year, would have to be credited. So again, we would need a debit to depreciation expense and a credit to this account, accumulated depreciation for the delivery truck. Now we're not doing that right now, but one thing to keep in mind if you're the accountant for this business, this truck was bought on March 22nd. So if your accounting period is 1 year, this entry down here would be 12/31/19, and it would be credited, but not for a full year. The first time it would be credited based on an amount or a number of days from March 22nd to December 31st. So just keep that in mind. We're not going to get that complicated right now, but rarely do you buy everything on January 1st. It's not that simple. So for the first year, the credit would be less than it would from the years to follow. Let's go back to the cash payments. The next three entries are closing entries, and again, as I may have told you earlier, we simply need a journal that has a general debit and a credit column. This one does. We could also use cash receipts journal if we wanted to. But at the end of the accounting period, let's assume for this business now, the local hardware store, let's assume that it has a monthly accounting period, so we're using March 31st. These are the three closing entries, and we've had them before, but remember that they do three things. First one closes sales. So if you look at sales, it would have a credit balance, in this case of $5,000. To close it, we need to debit $5,000. That would make it have a zero balance. And the credit here goes to income summary. And here we have a brief description of the thing. These two slash marks are not required, but sometimes it helps because it may look as if you forgot a source document. There really is no source document for a closing entry. So the slash marks indicate that nothing needs to be put there. When we post it, then the account numbers would go there. The second closing entry closes all of these expense accounts. They all have debit balances, so if we want to close them, we need to credit each one of those by the balance. And when you add up the three expenses, it comes to $583. Income summary then is debited by the $583. We credit the expenses and then they will be closed. And a brief description. Again, we skip a line simply to clarify so that it's clear that we have a new transaction starting. The third closing entry will close the income summary account, and that will be debited. We're not doing all the posting right now, but if we did, we would have found that the income summary account back here would be credited by $5,000. Here, same account is debited, $583. That would have left a balance if you subtract the two. If you did the posting, you would see a balance, a credit balance of $44.17. So to close the income summary, we need a debit of $44.17. And the owner's equity is credited, and that increases. So basically, all the money from sales and all the money from expenses, all those accounts are closed, and that in the end increases the value of the business. Owner's equity account is credited. So that indicates that we made a net income this time. And again, a brief description at the end. So as always, these videos can be a good source of review when you get stuck on a problem or when a test is coming up. It's good to go over these again. You should be able to pause and back up and listen to them again, but they're there for you to use, so make use of that. At this point, I would ask you to go to your course page, and there will be a problem very similar to what we just did with these kinds of entries.